You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. This week is going to be a rinse and repeat. Last week, we looked at a skip strike butterfly in United Airlines. And one of the main rationale behind looking at these butterflies in this time period is that implied volatilities are just so high across the board. The volatility index for the S&P 500 index, the good old VIX, that's trading north of 30%. We're seeing real high implied volatility in all the travel stocks. United Airlines on a 30-day basis is looking at 100% implied volatility. Now, they are going to be announcing earnings here mid to end July. We're going to totally avoid that. We don't want to deal with earnings, and we mentioned that on last week's call when we looked at our butterfly. There's just so much volatility that we don't need that unknown event like an earnings report. And on top of it, last week's call, when we looked at the skip strike butterfly, which is a little different than what we're going to talk about today, I don't want to bore you with the exact same strategy. So we're going to do something similar but different. It's going to be a ratio butterfly. But the stock was trading at around 39 at that time. We sold the 49 strike call. We did it out of the money, obviously. And we skipped the 52 and we bought the 55 and we bought the 47. So the stock was at 39, and basically the next day, the stock never saw 39 again since last week. So it went straight down. And right now we're taping Options Playbook Radio. It is the 25th of June. The markets are open, and we see United Airlines trading at 33.09. So the short strike was never in play so far since we did that trade. And so we're going to come back and we're going to look at another trade. And you can compare the two. I think this is one good way to try to get your hands on if you might want to do a ratio butterfly as opposed to a skip strike butterfly. And this is an underlying that I would consider doing. Now, not meant to be a recommendation, but when I have high implied volatilities in the stocks that usually don't have high implied volatilities, and I almost feel like there's a need to do a strategy like this, something that's going to take advantage of those volatility premiums. Okay. So the trade that we're going to look at today, based off of the stock at 33.09, is we're going to do the July 10th expiration. That's 15 days away. We're going to buy the 39 strike call. We're going to sell 3 of the 41 strike calls, and we're going to buy 2 of the 43 strike calls. Now, when you're looking at a ratio spread, here's the rule of thumb. The number of legs that you buy need to match the number of legs that you sell. So we're buying one of the 39, selling two of the 43. That adds up to 3. And in order for us to be covered, then that means we can only sell 3 of the 41 strike calls. The concept is the same as a skip strike butterfly in that we are selling an extra credit spread to try to pay for the butterfly. That's the whole goal here. And also, we want to make sure that the stock can get to the price, but we don't want it to get there that fast. So if I look at the long straddle is trading fairly close to $6, just under $6. And so you take 6, you add that to 33, you come up with 39. I feel fairly comfortable with that strike based off of what the marketplace is telling us. If we did that whole, that we set up that whole option trade, right now that midpoint is trading at 10 cents. Like I said, the market is open right now. So if you can't always guarantee a midpoint fill, but it's a 10-cent net credit to the account. That means that if the stock just stays where it's at, I'm going to make that 10 cents on this underlying. Last week when we did the skip strike, we brought in a little bit more credit. We brought in about 43 cents, but that was a different setup and a different time. This week, we're going to be looking at this 10-cent net credit to the account. Now, if you're looking at this as opposed to going out and actually selling just the 41 strike call and buying the 43 strike call, that's trading actually for about a 20-cent net credit. So my proposal here on these high-priced, high implied volatility underlying stocks where we just had the vols just stay sustained up over 100% implied volatility, when we're looking at those type of underlyings that we're trading in, you're tempted to sell some call premium. But when you do that, you don't have any hedge, you don't have any risk. You're bringing in a 20-cent net credit. Yeah, granted, you can go way out of the money because of the implied volatility. But if the market starts coming towards you, you basically got to close out your position. In other words, if you are at risk of losing that entire $2 because the market is moving rapidly towards your short strike, your only real defense there is to actually just close the position, or you got to roll it further out in time. So this trade actually puts the hedge right into the trade. You give up about half of the net credit that you would have received if you did the trade, if you just did the short trade. So instead of getting a 20-cent net credit, we're going to try to get a 10-cent net credit. But the other thing that's interesting about this is that I'm more apt to let this one just go all the way to expiration. Why? Because I'm not as worried if the stock starts coming towards my short strike as expiration approaches, because I could actually benefit from this trade. If it stopped right at 41, that's where my biggest benefit would be and my maximum gain could occur. That means that if it stopped at 41, we'd have a $2 gain minus the 10-cent net, or plus the 10-cent net credit to the account would be $2.10 of upside. Now, don't forget commissions. You always want to add commissions. And then our downside is from 41 to 43. If it closed above 43, well, then we'd have 2 points of risk there, minus the net credit received around 10 cents if we could fill at that midpoint. And that means you'd have $1.90 worth of risk if the stock went all the way up above the 43 strike. So I'd put this trade on. I would watch it. I wouldn't try to hedge it. I wouldn't try to trade it. If the stock, for some reason, instantly tomorrow ran up to 43, I would just take it off. In other words, I'd get out as fast as I could if it happened right away. But if it happened closer to expiration, I'd just watch it and see where it lands. All right. Well, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at TheOptionsGuy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.